Hey everyone, welcome back to Corporate Decoder, the place where we decode financial documents to find the hidden stories within them. Now get ready, because today we have a treasure trove of financial information from Prospect Floating Rate and Alternative Income Fund Inc., its latest 10K report. And let me tell you, there are some juicy numbers and key risks we need to dive into. Before we get started, make sure you're subscribed to Corporate Decoder if you love getting straight to the point analysis of these complex filings. And hey, if you want to discuss these insights further, join our Discord community. The link is in the description below. Prospect Floating Rate and Alternative Income Fund Inc. is essentially an investment company that wants to make money by lending to and investing in private US middle market companies. Think of them as a specialized lender looking for income and occasionally some growth from these businesses. They've elected to be regulated as a business development company, or BDC, which comes with its own set of rules and strategies. This filing covers their fiscal year ending in June 2025, giving us a look at their performance. Over that period, they are aiming to generate income by mostly investing in floating rate loans and other income generating investments. At least 80% of their assets are earmarked for this focus. Now, every investment comes with risks, and this report doesn't shy away from them. One major point is that they have to maintain their status as a BDC and ARSC, or regulated investment company, for tax purposes. If they fail to meet the strict rules for these classifications, it could significantly impact their flexibility and even lead to corporate taxes wiping out profits. The report states, a failure on our part to maintain our qualification as a business development company would significantly reduce our operating flexibility. This means if they mess up the BDC rules, they might be in big trouble losing their special tax status and all the benefits that come with it. Their core strategy involves lending to and investing in private companies. And as the report points out, our investments in prospective portfolio companies may be risky, and we could lose all or part of our investment. That's a crucial warning. Investing in private companies, especially smaller and mid-sized ones, is inherently riskier than buying stock in big public companies. These smaller businesses might not have as much information available about them, and they can be more sensitive to economic ups and downs. Adding to the risk is that many of these companies they invest in might already have a lot of debt. The report highlights our portfolio companies may be highly leveraged. When a company is already loaded with debt, it makes them more vulnerable if business gets tough. It's like a person with a lot of credit card debt. If they lose their job, they're in a really bad spot, and so are their lenders. They also invest in something called CLOs, or collateralized loan obligations. Think of these as bundles of loans that are sliced up into different risk levels. Investing in the riskier parts of these bundles, especially the equity and junior debt tranches, as the report mentions, means they're taking on a lot of risk. Our LL investments will be exposed to leveraged credit risk. This means if the loans within the CLO bundle go bad, it can hit them even harder because of that leverage. A big challenge in their strategy is focusing on private companies. The report acknowledges an investment strategy focused primarily on privately held companies presents certain challenges, including the lack of available information about these companies. With public companies, there's a ton of data available, but private companies can be more opaque, making it harder to fully understand the risks before investing. Now let's get to the numbers. The heart of this report. It's crucial to see how they are actually doing financially. Let's look at their consolidated statements of assets and liabilities as of June 30, 2025. Their total assets stood at roughly $102.9 million. On the flip side, their liabilities were about $39.9 million. That's a solid increase from June 30, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2024, when their net assets were around $31.2 million. So on the surface, things are moving in the right direction in terms of overall size. A big part of those liabilities is their senior secured revolving credit facility, which was $45.5 million on June 30, 2025. This is how they borrow money to invest, and it shows they are using leverage to boost their potential returns, but it also amplifies risk. Looking at the per share value for their Class A common stock, it sat at $4.50 on June 30, 2025. This is a decrease from $4.69 on June 30, 2024, indicating a slight drop in the value of each share over the year. When the value per share goes down, even if total assets grow, it means either they issued more shares or the investments themselves didn't perform as well on a per share basis. Their total investment income for the year ending June 30, 2025 was about $9.4 million. This is a significant jump from around $3 million the previous year in 2024. This surge in income is a good sign and likely reflects their increased investments and possibly a better interest rate environment for their loan portfolio. The company has a distribution reinvestment plan, which means some stockholders choose to automatically reinvest their dividends to buy more shares. For the year ended June 30, 2020-2025, they issued about 592,000 shares of Class A stock through this plan worth around $2.7 million. This shows investor confidence and a commitment to reinvesting, which can boost the company's capital base. Looking at their net investment income loss for the year ended June 30, 2025, they actually had a positive figure of about $3.6 million. This is a huge improvement from a loss of roughly $214,000 in 2024. This turnaround is a really strong indicator that their investment strategy is starting to pay off. However, it's not all smooth sailing. Their net realized losses on investments for the year ended June 30, 2025 were about $2.1 million. This means that when they sold some investments, they actually lost money on them. This is a stark reminder of the risks involved in their investment strategy, especially with private companies. Then there's the net change in unrealized gains to losses on investments, which for 2025 was a loss of about $295,000. Unrealized losses mean the value of their current holdings went down on paper even if they haven't sold them yet. This combined with the realized losses shows that the overall value of the portfolio took a hit during the year. As of June 30, 2025, their total portfolio investments as a percentage of net assets was a whopping 213%. This high percentage indicates they are using a significant amount of leverage to fund their investments, which magnifies both potential gains and potential losses. It's a high stakes game when you're leveraged that much. Digging into their fair value at June 30, 2025, the report shows a total of about $85 million in portfolio investments. A huge chunk, about $77.5 million, is in senior secured loans, first lien, representing 91% of their total portfolio value as of that date. This tells us they are heavily focused on this type of investment. Comparing this to June 30, 2024, their portfolio was about $59.4 million. So there's a substantial growth in their investment portfolio over the year, which is generally a good sign if the investments are performing well. Let's look at where their money is invested by industry. The healthcare and pharmaceutical sector makes up 27% of their portfolio, at fair value representing almost $23 million. This is a significant concentration, so any major changes in that industry would directly impact P-float. The automotive sector accounts for 9% of their portfolio. And telecommunications is another significant chunk at another 9%. It's good they're diversified across industries, but those top sectors are definitely ones to watch. Now let's talk about their borrowing. Senior secured revolving credit facility, outstanding balance was $45.5 million on June 30, 2025. This is a crucial number because it represents a large chunk of their liabilities. The facility has first priority on almost all their assets, meaning if they can't pay it back, the lenders get paid first. For the year ended June 30, 2025, their interest expense and credit facility expenses were over $3.7 million. That's a substantial cost of doing business and highlights the impact of their leverage. It's significantly higher than the previous 2 years, showing they are using more borrowed money or paying higher rates. From a Warren Buffett perspective, this company is playing a carefully managed game of high yield lending. They aim for income with a secondary focus on growth by investing in middle market private companies. Their strength lies in their advisors' experience and their strategy of focusing on senior secured loans, which theoretically offer better protection. However, the reliance on leverage, significant investments in C-close, and the inherent risks of private company lending are substantial. The growth in their portfolio and investment income is encouraging, but the realized and unrealized losses on investments highlight the volatility. So what's the story here? Prospect Floating Rate, an alternative income fund, is actively growing its investment portfolio. and has seen a substantial increase in investment income. They're using leverage to amplify returns, a strategy that works well in good times, but can be dangerous in bad times. The focus on senior secured loans offers some protection, but the concentration in certain industries and the inherent risks of private lending and CLOs remain a concern. The company's future success heavily relies on its ability to manage these risks effectively and continue to grow its income prior returns and interest rate fluctuations. What's your take on prospect floating rate and alternative income fund strategy and financial health? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more breakdowns like this. And don't forget to join our Discord community linked in the description. We're building a great space to discuss these filings and more. Thanks for watching and see you next time.